Let me tell you something I learned the hard way, sitting alone with my tape and my charts, watching prices move the way men move when fear and hope take turns at the wheel. The market doesn't ruin most traders with big losses. No, that would be too obvious. It ruins them with small, comfortable wins. The kind that feel good. The kind that make you nod your head and say, "I'm doing fine." Have you ever noticed how dangerous that sentence really is? You see, a small win has a peculiar effect on the trading mind. It calms you. It reassures you. It tells you that what you're doing must be right, even when it isn't. A man who takes quick profits begins to believe his job is to snatch money from the market before the market can snatch it from him. That belief feels sensible. It feels cautious. But in speculation, caution often disguises ignorance. Ask yourself honestly, are you taking profits because the market tells you to, or because you're afraid to sit still? I've watched traders take 5 points out of a move that had 50 written all over it. They did it with pride, too. They patted themselves on the back and said, "A profit is a profit." That phrase has probably done more damage to trading accounts than bad news and crooked tips combined. A profit is not a profit if it trains you to think small. The market doesn't reward nervous men over time. It rewards men who can sit tight when they are right. Can you sit tight, or do your hands itch the moment you see green on the screen? Small wins teach you the wrong habits. They teach you to trade your emotions instead of the trend. Every time you take a quick profit, you are telling yourself that the market is something to be beaten in a hurry, not understood and followed. You start hunting for action instead of position. Before long, you're no longer reading the chart. You're reacting to it. And reaction is always late. Have you noticed how the market never seems to wait for you once you start trading that way? The real money, and I mean the money that builds an account instead of decorating it, comes from the big swing. It comes from being right and staying right. But small wins rob you of that possibility. They cut your winners short and leave your losers to wander. That's the cruel arithmetic of trading. Losses take care of themselves by growing, while profits require discipline to grow. Do you see how backward that is from what most people do? There is another danger in small wins that most traders don't recognize until it's too late. Small wins give you confidence without competence. You begin to think you've mastered the game because you've strung together a few profitable trades. But the market has seasons, just like business and life. Easy markets make poor teachers. When conditions change, the man trained on small wins has nothing to fall back on. His method depends on being right quickly, not deeply. What happens when the market stops being quick? I've always said that speculation is a business, not a pastime. No business survives by celebrating small sales while ignoring the cost structure. In trading, your costs are commissions, slippage, and most of all, mental wear and tear. Frequent small wins encourage frequent trading. Frequent trading increases costs and dulls judgment. You get tired. You get sloppy. And the market senses that, because the market always exposes weakness. Have you ever wondered why your best trades come when you do the least? The chart tells its story slowly. It doesn't shout. It whispers. Trends take time to develop, and fortunes are made by those who listen longer than others are willing to. When you grab small wins, you stop listening. You interrupt the story before it reaches its conclusion. You leave the table before the meal is served. And then you complain that the market never gives you the big moves. But were you ever there long enough to receive them? There's also a deeper issue at work here, one that has nothing to do with indicators or patterns, and everything to do with mindset. Small wins feed the need to be right. Big wins require the humility to let the market be right. That's a hard lesson for most men. We like control. We like closure. Taking a small profit gives both. Letting a winner run feels like surrender, even though it's the opposite. Are you trading to feel smart today, or to build capital over years? I've known traders who could call the market correctly again and again, yet never made real money. Their charts were sound, their timing decent, but their profits were thin and fleeting. Why? Because they feared giving back paper gains more than they desired real wealth. They were protecting feelings, not capital. The market doesn't pay for emotional comfort. It pays for correct positioning and patience. Can you accept temporary discomfort in exchange for long-term growth? Every great move begins with boredom. Prices go sideways. Shake out weak hands and test conviction. The trader trained on small wins can't survive that phase. He needs movement. He needs affirmation. So he takes his profit and moves on, just as the market is preparing to do its real work. Later, he watches the chart and tells himself he would have held if only he'd known. But the truth is, he knew. He just didn't trust himself enough to wait. Small wins also distort your sense of risk. When you take profits quickly, you start increasing position size to compensate. You want the same excitement, the same dollar impact. That's when the market catches you leaning. One ordinary loss wipes out 10 careful wins, and you're left wondering how a system that worked could fail so suddenly. It didn't fail. It revealed itself. The math was always against you. Did you ever sit down and truly calculate that math? The old-timers used to say that the market is never wrong, but opinions often are. Small wins are opinions dressed up as prudence. They assume the market will turn against you unless you escape quickly. But when you are trading with the trend, the market is on your side. Why run from an alley? Why not let him do the heavy lifting while you simply stay out of the way? I don't mean that a trader should never take profits. That would be foolish talk. I mean that profits should be taken for reasons grounded in the chart and the tape, not in fear or impatience. There is a difference between a planned exit and a nervous one. The market knows the difference, even if you pretend not to. When you look at your last trade, can you say honestly which kind of exit it was? The tragedy is that small wins feel like progress. They keep you busy. They give you stories to tell. But wealth in trading is quiet. It comes from a few decisive moments handled correctly. Most of the time, the successful trader is doing nothing at all. That's a hard lifestyle for a man who equates activity with achievement. Yet the market rewards restraint more than effort. How comfortable are you with doing nothing when nothing is required? If you study the great price movements of history, you'll see the same lesson repeated. The big money was not made in the buying or the selling, but in the waiting. Small wins teach you to avoid waiting. They train you to believe that the market owes you something now, but the market owes you nothing. You earn what you take by aligning yourself with its rhythm, not by interrupting it. And so the trader who lives on small wins stays forever at the edge of success, close enough to taste it, never close enough to hold it. His account rises slowly and falls suddenly. His confidence comes and goes. He keeps searching for new methods, new indicators, new tricks, never realizing that the flaw is not in his tools, but in his habits. Until a man learns to let his profits run and his ego rest, the market will continue to teach him the same lesson in different ways. Frequent profits feel safe, and that feeling is exactly what makes them dangerous. The market has a way of rewarding behavior that looks sensible on the surface, while quietly punishing it underneath. A trader who collects small gains day after day begins to believe he has found balance. He sleeps well. He feels in control. But the market is not in the business of providing comfort. It is in the business of exposing faulty arithmetic. Have you ever asked yourself why something that feels so safe rarely leads to real progress? The trouble starts with how the mind interprets repetition. A few small wins tell you that your method works. A long string of them convinces you it is reliable. But reliability without depth is a fragile thing. The market changes character, volatility expands, trends lengthen, and suddenly the same approach that once felt prudent begins to lag behind. Yet the trader doesn't notice right away. Why would he? The account isn't collapsing. It's just standing still. Isn't standing still better than losing? Or so it seems. Expectancy is the part of trading most men avoid thinking about, because it requires honesty over excitement. Expectancy doesn't care how often you win. It only cares about how much you win compared to how much you lose. Frequent profits usually come from taking trades off early, long before the market has revealed its full intention. That habit compresses your upside while leaving your downside untouched. Losses are still losses. They don't shrink out of politeness. Do you see how that imbalance creeps in quietly? When a trader feels safe, he stops questioning his assumptions. He stops reviewing his trades with a critical eye. After all, the account is green more often than red, but green doesn't mean efficient. It doesn't mean optimized. It only means the market has not yet demanded payment. Small profits are like borrowed time. They postpone the reckoning, and postponed lessons have a way of becoming expensive lessons later. Have you noticed how the market always collects with interest? There's another subtle cost to frequent profits. They distort your sense of opportunity. When you're accustomed to taking money quickly, you stop seeing the market in terms of campaigns and start seeing it in terms of transactions. In and out, in and out. The chart becomes a series of excuses to act instead of a structure to study. You're busy but not effective, active but not aligned. Are you trading the market's move, or are you trading your own need to feel productive? Small, consistent gains often encourage position size creep. The trader wants more impact, more reward without changing his habits. So he increases size instead of patience. That's when the math turns against him. One normal loss erases weeks of careful progress. He tells himself it was bad luck, but luck has very little to do with it. The imbalance was always there. The market simply waited for a moment when it could no longer be ignored. How often do you blame timing when the real issue is structure? Frequent profits also weaken conviction. If you've trained yourself to exit at the first sign of discomfort, you have no framework for holding when the trade really matters. Big moves don't unfold smoothly. They pull back. They test belief. They make you question yourself. A trader raised on small wins has no tolerance for that discomfort. He exits not because the trend is broken, but because his nerves are. And once he's out, he watches the market do exactly what he anticipated without him. How many times have you watched a chart continue without you? There's a psychological trap here that few men escape early. Small wins create the illusion of mastery. The trader feels smart. He feels sharp. He begins to believe that avoiding losses is the same as making money. But avoiding losses is only defense. Wealth is offense. And offense in trading means allowing the market enough room to pay you properly when you are right. That requires accepting periods where open profit fluctuates. Can you tolerate seeing gains come and go without interfering? Markets are designed to frustrate the majority. They reward patience only after testing it. The trader who lives on frequent profits never stays long enough to pass the test. He leaves the exam early, content with partial credit, unaware that the real score is determined later. Over time, his equity curve reflects that decision. Flat stretches, slow grind, sudden setbacks. He keeps working harder, trading more, studying new techniques, never realizing that the core issue is not knowledge, but restraint. Do you honestly believe more activity will fix a problem caused by impatience? Small profits also weaken your relationship with risk. When gains are modest, losses feel oversized. Fear increases. Stops tighten. Trades become defensive. You're no longer positioning for what could happen, only protecting against what might go wrong. That mindset shrinks opportunity before it ever reaches your account. The market doesn't move to accommodate fear. It moves according to supply and demand, regardless of how safe you want to feel. Are you trading the chart, or are you negotiating with your anxiety? The most damaging part is that frequent profits delay growth. They keep you just comfortable enough to avoid change. You don't blow up, so you don't rebuild. You don't fail spectacularly, so you never correct the underlying flaw. Years pass. Experience accumulates, but progress doesn't. The trader wonders why effort hasn't translated into results, unaware that safety has been quietly draining expectancy all along. Frequent profits feel safe, but safety in trading is often just slow motion risk, unfolding one small win at a time, shaping habits that look sensible today and become limiting tomorrow. Especially when the market finally offers a move large enough to matter and the trader realizes he has trained himself to step aside just when patience is required most. Small wins have a way of flattering a trader long before he has earned the right to feel confident. A few profitable trades can make a man feel sharp, even clever, and that feeling settles in faster than any real understanding ever does. The market allows this because it knows confidence built on shallow ground cannot stand for long. Have you noticed how easy it is to feel skilled when nothing has really been tested yet? Confidence is a powerful thing in speculation, but only when it is supported by experience that has survived pressure. Small wins skip that process. They arrive quietly, without demanding discipline, without forcing patience, without asking the trader to sit through uncertainty. The trader begins to believe he understands the market when, in truth, he has only been tolerated by it. That difference matters more than most care to admit. Are you confident because you've been right, or because you haven't been challenged? Real trading skill is forged when the market moves against you, while your premise remains intact. It is learned in the waiting, the holding, the refusal to act just to relieve discomfort. Small wins bypass all of that. They give you results without resistance, and results without resistance teach nothing. The trader learns how to enter, perhaps, but never how to stay. He learns how to exit quickly, but never how to think long. How can a man claim mastery of trends he has never followed to completion? The danger is not that small wins feel good. The danger is that they feel deserved. The trader begins to credit himself for outcomes that had little to do with skill and much to do with favorable conditions. Easy markets are generous teachers, but they teach the wrong lessons. They reward speed over judgment and activity over alignment. When conditions change, the trader's confidence remains, but his foundation disappears. Have you ever felt sure of yourself right before realizing you didn't know as much as you thought? Small wins inflate confidence because they are frequent. Frequency creates familiarity, and familiarity creates belief. The trader starts trusting his instincts, not realizing those instincts were shaped by an environment that no longer exists. He mistakes repetition for reliability. He confuses motion with progress, and because nothing painful has happened yet, he assumes nothing is wrong. That's how false confidence grows, quietly, comfortably, without interruption. A trader who has never held through a deep pullback doesn't know what conviction feels like. He knows relief. He knows the comfort of closing a trade and being flat. But he doesn't know the discipline required to remain exposed while the market tests resolve. That skill cannot be learned from small wins. It requires time in the trade, time under pressure, time watching unrealized profits fluctuate without interference. How confident can a man be if he has never stayed long enough to be truly uncertain? There is also a difference between being accurate and being effective. Small wins often come from accurate entries paired with ineffective exits. The trader sees this as success because accuracy feels like skill. But markets don't pay for accuracy alone. They pay for positioning and patience. A man can be right 10 times and still be poorly trained if each of those times taught him to avoid discomfort instead of manage it. Do you judge your skill by how often you win, or by how well you handle being right? Inflated confidence leads to complacency. The trader stops studying. He stops reviewing mistakes because, in his mind, there are none worth examining. Losses are brushed off as anomalies. Wins are seen as confirmation. This selective attention strengthens the illusion. Over time, the trader becomes emotionally invested in the idea that he is skilled, and that investment makes learning harder, not easier. How open are you to improvement when you already believe you've arrived? When real adversity finally appears, inflated confidence turns brittle. The trader reacts emotionally because he has no reference point for sustained difficulty. He hasn't built the muscle memory required to endure drawdowns with composure. His confidence was never stress-tested. It collapses quickly, and panic fills the space where discipline should be. That panic leads to overtrading, revenge trading, and a desperate search for the safety of small wins again. Have you noticed how traders often regress under pressure instead of adapting? True skill in trading is quiet. It doesn't announce itself with excitement or urgency. It reveals itself in consistency of behavior, not frequency of profit. A skilled trader can be wrong and calm, right and patient. Small wins don't teach that balance. They teach celebration. They teach reaction. They teach the trader to associate success with immediate feedback rather than long-term alignment. That association becomes a liability when the market demands restraint. Another overlooked aspect is that inflated confidence often leads traders to increase risk before increasing understanding. They feel ready for larger positions because recent results support that belief. But position size magnifies flaws faster than it magnifies skill. What was once a minor habit becomes a major problem. The trader learns too late that confidence without structure is dangerous. The market doesn't care how confident you feel. It only responds to how prepared you are. Small wins also prevent the trader from developing respect for uncertainty. The market is uncertain by nature. Accepting that uncertainty is part of professionalism. But frequent profits create the illusion of predictability. The trader starts expecting outcomes instead of managing probabilities. When expectations replace preparation, disappointment follows. Do you trade assuming the market will behave, or do you trade prepared for when it doesn't? The most skilled traders I've known were never impressed by small wins. They viewed them as noise, not evidence. They waited for opportunities that demanded patience and rewarded discipline. Their confidence came not from how often they were paid, but from how well they understood when to act and when to wait. That kind of confidence cannot be rushed. It is built slowly, trade by trade, lesson by lesson. Small wins inflate confidence because they offer validation without requiring transformation. They let the trader feel accomplished without changing how he thinks, how he waits, or how he manages uncertainty. And as long as that confidence goes unexamined, it continues to grow, untethered from real skill, shaping decisions, guiding risk, and standing in the way of the deeper understanding that only comes when a trader is forced to confront not just the market, but himself. Especially in those moments when the chart stops rewarding quick decisions and begins asking for patience instead. The inability to sit still has ruined more traders than being wrong ever could. Being wrong is part of the business. It's expected. It's manageable. But restlessness, that constant urge to act, to adjust, to interfere, that is the quiet killer of trading accounts. The market can forgive a mistake, but it has no patience for a man who won't let a correct idea develop. Have you ever noticed how often trouble starts not when you enter a trade, but when you refuse to leave it alone? Most traders believe errors come from bad analysis. They think if they just read the chart better, add another indicator, sharpen their timing, they'll fix the problem. But the real damage usually happens after the analysis is done. The trade is on, the position is correct, and then the waiting begins. That's where most men fail. Not because the market proved them wrong, but because silence made them uncomfortable. How often have you talked yourself out of a good position simply because nothing was happening? Sitting still feels like doing nothing, and doing nothing feels like falling behind. That belief is deeply rooted, especially in men who equate effort with results. In trading, that belief is poison. The market doesn't pay for effort. It pays for alignment. Once you are aligned with the trend, your job is no longer to act, but to refrain from acting. That restraint is far harder than pulling the trigger. Can you resist the urge to manage what doesn't need managing? A trader who cannot sit still is constantly negotiating with the market. He moves stops too soon. He takes profits too early. He exits on noise and re-enters on emotion. Each action feels justified in the moment. Each one feels like protection. But taken together, they form a pattern of self-sabotage. The trader isn't responding to information. He's responding to discomfort. And discomfort is not a signal. Have you learned the difference yet? Being wrong teaches lessons. It forces review. It demands adjustment. It humbles. But impatience teaches nothing because it disguises itself as vigilance. The restless trader believes he is being careful. He believes he is managing risk. In reality, he is refusing to trust his own work. He makes a plan, then abandons it at the first sign of uncertainty. What is the value of analysis if you don't allow it time to prove itself? The market moves in waves, not in straight lines. Even the strongest trends breathe, they pull back, they pause. They test conviction. A trader who cannot sit still interprets these natural movements as threats. He exits, waits for confirmation, then watches price resume without him. Later, he tells himself the move was obvious. It was obvious only because he left it early. How many trends have you identified correctly, but failed to profit from? Restlessness also magnifies losses. A trader who interferes constantly often turns small losses into large ones by re-entering too soon or overcorrecting. He refuses to accept that a trade is simply wrong and finished. Instead, he tries to fix it with activity. More trades, more adjustments, more damage. Being wrong once would have been cheap. Refusing to sit still makes it expensive. Why is acceptance so much harder than action? There is a false sense of control that comes from constant involvement. Clicking buttons feels like authority. Adjusting stops feels responsible. But control in trading is largely an illusion. You control risk at entry. After that, the market does what it does. The disciplined trader understands this and limits his interference. The restless trader fights it, and the fight is always unequal. Do you really believe the market needs your help minute by minute? The inability to sit still often comes from fear disguised as professionalism. Fear of giving back profits. Fear of being wrong for too long. Fear of missing something. That fear keeps the trader glued to the screen, reacting instead of observing. Observation requires distance. Reaction requires proximity. One leads to clarity, the other leads to exhaustion. Which one defines your trading day? Many traders would improve overnight if they simply learned to do less, fewer trades, fewer adjustments, fewer opinions. Let the chart work. Let the trend develop. Let time do its job. Time is the most underused tool in trading because it demands patience, and patience offers no immediate feedback. Are you strong enough to wait without reassurance? A man who can sit still when he is right gains an edge that no indicator can provide. He allows probability to express itself. He gives his winners room to justify the risk he took. He understands that the market's greatest rewards are reserved for those who interfere the least once they are positioned correctly. That understanding doesn't come from books. It comes from resisting the urge to act when action is unnecessary. Being wrong is visible. It hurts. It demands correction. But impatience hides behind activity and intention. It looks like engagement. It sounds like responsibility. And because of that, it often goes unchallenged. The trader keeps working harder, never realizing that stillness, not effort, is what his situation requires. The market doesn't test intelligence nearly as much as it tests temperament. It asks whether you can endure uncertainty without reaching for control. It asks whether you can wait without reassurance. Those who cannot sit still never allow their ideas to mature, and those who never allow ideas to mature never find out which ones were truly worth trusting. Taking quick gains shifts a trader's focus away from market structure and toward emotional relief, and that shift is subtle enough that most never notice it happening. At first, it feels like discipline. You take the money, you step aside, you tell yourself you're being prudent. But the market does not measure prudence the way men do. It measures alignment, and alignment is something that reveals itself over time, not in the first few favorable ticks. Have you ever stopped to ask why relief feels so urgent the moment a trade goes your way? The chart has its own language, and it speaks in phases. Accumulation, expansion, pause, continuation. None of these phases are quick if they are genuine. When a trader rushes to take profit, he is no longer listening to that language. He is interrupting it. The trade stops being an expression of structure and becomes a transaction designed to soothe nerves. That's a dangerous habit, because once relief becomes the goal, clarity disappears. Are you reading the market, or are you negotiating with your feelings? Emotional relief is immediate. Market structure is patient. The two rarely coexist. A trader who takes quick gains is usually responding to the internal tension of having money at risk, not to a change in trend or behavior. The chart may still be sound, the volume supportive, the price acting exactly as expected, yet the trader exits anyway. Why? Because being right feels uncomfortable when it is unrealized. Paper profits tease the mind. They feel temporary, fragile, undeserved. Do you trust your analysis enough to let it breathe? Once emotional relief becomes the reward, the trader begins to optimize for comfort instead of opportunity. He chooses exits that make him feel good rather than exits that make sense. Over time, this reshapes how he sees the chart. He stops looking for structure and starts looking for exits. Support and resistance become excuses to close trades early. Minor pullbacks become threats. Normal pauses become warnings. The chart hasn't changed, but his relationship with it has. Have you noticed how fear can rewrite what you think you see? Market structure requires context. It requires stepping back and seeing how price behaves over hours, days, sometimes weeks. Quick gains narrow that perspective. The trader becomes fixated on short-term fluctuations because those fluctuations offer frequent chances for relief. He trades the noise because the noise is loud. Structure is quiet. It doesn't demand action every minute. And that silence makes the emotionally driven trader uneasy. How comfortable are you with quiet charts? There is a hidden cost to this shift in focus. When emotional relief becomes the objective, consistency becomes impossible. The trader is no longer executing a plan, he is managing sensations. One day he holds longer because he feels confident. Another day he exits early because he feels uncertain. The same setup produces different actions depending on mood. That inconsistency erodes trust in one's own process. Without trust, hesitation grows. Without hesitation, mistakes multiply. Do you recognize when your decisions change even though the setup hasn't? Quick gains also distort feedback.